Obviously, it is people. The people is the greatest answer into running any business well. But that doesn't mean they just appear out of thin air, and it doesn't mean that they're not expensive. You have to invest in them both on an emotional, a personal, and a financial side in order to get them to stay and be effective for you. And so one of my business principles, business principle number 12 for me is when performance is measured, performance improves. When performance is measured, the rate of improvement accelerates. So I wasn't measuring the right things and paying attention to the right things. And that really goes into something called elasticity. Elasticity really goes into saying, what are people willing to pay for something?
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
So how did you even come up with the idea of like, I want to buy a McDonald's, like I'm going to buy a restaurant and move out of state to do it? Like not like, oh, there's happening to be one for sale and I know the guy or something like that, but just.
Are we like, do you want to be
we're going. Yeah.
So like McDonald's was not, it wasn't like my initial option. I didn't really have a plan as a kid. Most kids don't, right? You're going through high school. You're like, well, I think I'll go to college because that's just what you do. And you're not really sure how you want to do it. So then I joined the military, just trying to figure things out. I'm like, well, I need some way to pay for school. It kind of sounds fun, blowing some stuff up once in a while. I don't know. I was just trying to figure it out. So I National Guard Army.
Okay.
But then like I worked at McDonald's since I was 14. And then I kept leaving and going and doing other things, like did some farm work, worked at grocery stores, stuff. And then you go back to McDonald's and then went on a Christian mission for 2 years, came back, did McDonald's again. So like I just kept going and then got deployed, went to Iraq, came back, McDonald's again. So I wasn't actually committed to McDonald's for a real long time. But I'd spent a lot of time with McDonald's because I was doing it. And every time that I was inside of it, I was being successful at the level I was at. And then every time I came back, I was able to level up or move up and get promoted. And I'm like, oh, okay. And then I was able to find success again. So learning and understanding the systems and processes worked. And eventually I'm just like, all right, I guess this is it. Yeah.
So you went from, you're a veteran, come back from Iraq.
Yeah.
It sounds like you're like a manager at that time at a McDonald's location.
Yeah.
Northern Utah?
Yeah, central Utah.
Central Utah.
And at the point, so then I became what we call a district manager, area supervisor, what we call a regional guy. And I started overseeing 5 restaurants. And then that's when I had the opportunity to buy my first. And that's when I moved down here to St. George.
So it's like kind of the American dream a little bit is what it sounds like, right? Literally, right? Kid growing up in McDonald's and now you own...
I have 18
stores. You're pretty public about it.
Yeah.
Served in the military, like you've checked a lot of boxes. What's more American than serving in the army and owning McDonald's and McDonald's, right?
Yeah, all of it for sure.
But being a district manager, like, or even just having a background, right, like that, I guess what I'm really trying to highlight is it doesn't sound like you grew up with money, went to college, got an MBA, and then found this great investment opportunity of, McDonald's is going to be the greatest franchise to buy. And you had seed money to down payment and get some SBA lending. Like you're working hard. And then one day it drops in your lap. Hey, there's some stores for sale in St. George.
Dude, that's
or were they new or they existing? Or?
No, they were existing. They were existing. And there were 3 down here. Now there's, I think I have 7 when you look at St. George and Washington combined, just because we've been able to build up and population growth as well. But no, you're exactly right. Like I did not have like true intentions or a vision of what I wanted to do with my life. I just knew that at that point I was going to try and do my best with what I had, and I was able to develop skills and grow and be able to find success. And then things just opportunities opened. And, staying true to one brand, I know I say that, but I left a couple times and kept coming back, but I kept going back to where I was able to find success. And then I would go and learn some other skills, have some different experiences that then helped me when I returned to McDonald's and do it again. and going through McDonald's, because they have what's called Hamburger University. So it's something
Yeah.
that people, like, they always think I'm kidding when I got a degree in hamburgerology, but no, it's 100% true. But McDonald's, they teach you basically everything that you would learn to get an MBA. And I know that because later on I went and got my MBA. So after, as a McDonald's franchisee and owner operator, I went through Western Governors University, where it's a competency-based university. You basically show everything you know. They pass you off on the class as you show what you know, or you can take normal classes, whatever you want to do. But I got my MBA in 6 weeks. Like, I wasn't trying to speed through it, but it was just like, oh, I know this stuff. And at McDonald's, it taught me everything I knew. And so the only thing before I became an owner was I had an associate's in arts. I had basically nothing.
Yeah, it's so what is it? Do you mind if can we talk about like the financial side of acquiring
I'd love to,
McDonald's?
yeah.
Like, so because I've had people ask me about franchising, right? Like, and it's always like, hey, should we be investing in a franchise? Should we be doing this? And there's really like kind of two ways to do it, is what I've generally observed. Is one is the Shack way, right? Just like, you have more money than you know what to do with. So you buy blue chip franchises, you hire all the people, and it's like just this good, maybe alternative idea, private investment for yourself. But like, obviously Shack is not owner operating a Burger King, right?
Oh,
he's, you know what I mean? You just hire people from day one, district managers all hired, everything, right? It's like, you're just trying to hire or buy a turnkey investment, right? That's one. The other way is the owner operator route. And that's what I've seen people be successful. It sounds like that's the route.
That's the route, but it's really the franchise you choose is going to dictate which of those options you're going to do.
Well, what I have largely found is oftentimes, if people aren't careful, you quickly go from making an investment to buying a job.
Correct.
Right. And that's, so like, talking about the finances, I think, like, what is the level, or, what should somebody be prepared financially to commit to if they're like, hey, I'm trying to go the owner operator route, right? Like, I know I'm going to have to work this job as part of my investment. And then on the other end of the spectrum, what does somebody need to be kind of prepared financially? What does that look like when you just are like, I'm going to open a franchise and plug and play?
Yeah. And I'd love to talk about both, because there's a lot of people who assume investing into a franchise is just going to be passive income. And so I'd love to talk about that in a minute. But McDonald's and every other franchisor, they're going to have different financial requirements so for McDonald's, it's a 25% equity stake in all. So depending on what you have, and they're gonna allow you to purchase one in the beginning, make sure that you operationally are sound, you're meeting all their screens, taking care of the customers, all that kind of stuff before they allow you to start buying more. Franchise fee is pretty small. It's $45,000. It's been that way ever since the beginning of time for McDonald's Corporation. And a lot of people don't understand what those mean. I mean, the franchise fee is basically, in the McDonald's world, it means that one location, I now have rights to exercise the franchise there, manage the franchise with my own management company for a period of 20 years. But those franchises, when I buy one from a different existing owner operator, I am now in his time frame. So those 20-year franchise fees, they just come. But if I buy a restaurant from somebody else and it's already 14 years into that lease agreement, I will only get it with 6 years.
Yep.
And so thinking about it as I'm purchasing it, I could maybe only have it for 6 years, and McDonald's may not want to rewrite that agreement with me because they may not like what I'm doing. So there's a whole lot of ways to look at that. So that's one of them, 25% equity. They want you to have what's called a cash flow coverage ratio. So basically it's taking EBITDA and it's saying, do you have 1.2 to 1 on debt? So your earnings before income, tax, depreciation. Basically, do you have 20% above what you're going to pay in debt? So that 1.2, and then they look at your liability turnover. So how much money do you have coming in, and how many days of sales is it going to take you to pay for those upcoming expenses? Really, those are kind of the things. They also look at a leverage ratio. But those finance things, a lot of people think that you've got to know and memorize all that stuff. You do need to know them, but you need to have a great accountant. And so for most of us McDonald's franchisees, we use McDonald's accountants. Like they only work with McDonald's owner operators. They're very well versed in McDonald's language because there's also other requirements. I've got to send certain financial statements to McDonald's on a monthly basis. So my P&Ls, my balance sheet, they've got to be sent in a timely fashion, and they want them in a certain, like they're organized in a certain way, not just your normal general accounting practice type format. They have like their own format. So there's some things like that.
It is, and that's not a service by McDonald's corporate. That's a business that is separate, but all they do is McDonald's franchisees. Yeah.
My accountant is just a normal accountant, Aprio out of Atlanta. And they do like, there's a section of them just dedicated to McDonald's franchises. And then there's others like real estate side and all that kind of stuff.
But you find a specialized account that really knows the ins and outs of that franchise.
Yeah. And then when I do stuff that's kind of outside of the McDonald's world, which is frowned upon by McDonald's, like it has to be something completely passive. My franchise agreement says full-time and best efforts towards McDonald's. So if I want to buy some real estate and I just want to rent it out and have someone else manage it, I can do that. But my accountant's really good at, offering the advice or talking to their real estate arm of their accounting firm and saying, hey, how is that going to benefit?
That's interesting. So McDonald's actually locks you down to say like, you can't go buy some Airbnb properties and start managing those.
Airbnb,
that's maybe a gray area.
As long as I'm not managing it. Yeah. Because it says full-time and best efforts. So
okay.
When we're here today, it says, well, what are you doing right now? For me, this is full-time and best efforts. I'm like, not that I love every single thing about McDonald's, but I love 99%. And one of my goals is to be McDonald's best ambassador. So when I'm here and I'm talking about McDonald's and talking about their system and them being Americana and the greatest franchise in the world ever, like, I'm living up to that.
Interesting.
Yeah.
Okay. And so what's the, like, in general, when somebody's looking to franchise, like what are some of the questions that they should be asking or things that they should be looking at to consider? Like
you already dove into it quite a bit, that last question. So a lot of people assume, hey, I'm going to buy a franchise and they want it to just serve as passive income. But most people don't really understand what it means and what the return is going to become from that. Like they've never done something where they're looking at square footage and looking at what type of space and how many dollars they should pay per square foot. And they don't understand what the lease agreement's like and how many years. And then what happens if that 5-year lease agreement expires and they decide not to renew with you and you've got all your capital expenditures. So you bought fridges and freezers and you decorated and all that stuff. And now you don't have a place to put it. Like people, there's just so many things that people really need to look into before they dive into it. And then the other side is the operations side. They think that, all I have to do is find one good manager and then they'll run it for me, thinking that that's all a franchise takes. And obviously it is people. The people is the greatest answer to running any business well. But that doesn't mean they just appear out of thin air, and it doesn't mean that they're not expensive. You have to invest in them both on an emotional, a personal, and a financial side in order to get them to stay and be effective for you. So I have 18 restaurant leaders, so people that are general managers in a restaurant, and then 3 department managers underneath them, and then 10 shift leaders underneath them. So I have at least 13, 14 people, and then I have district and regional managers, and every one of those people is key to just getting the doors open every day and getting some food served to customers. And it's difficult. And people think, we're just going to open this up. I'll find one good manager and boom, it's just going to operate and give me money. And if it was that easy, they say if it was that easy, everybody would be doing it, but it's extremely difficult and there's a lot of risk.
Yeah.
Like the economy right now, right? It's changing. It's always changing. We're getting to a point where there's more credit card debt than there's ever been in history. People are starting to be tardy on house payments, right? The 90-day, forget what the
delinquency.
Yeah, delinquency. Like all those things are starting to show signs of some people struggling.
What are you guys seeing in your stores with your trends?
Yeah, same thing. So McDonald's, and this is where a lot of franchisees have made some mistakes over the last couple of years. We used to be known as the greatest value proposition across fast food. And during that whole COVID area, there was some changes to the business, and inflation was like crazy. And a couple of us got bit. Well, we all got bit a little bit by not keeping up with inflation, meaning our costs shot up by 20, 30%, and we only raised our prices by 2, 3, 5%. And I had one of my greatest revenue years and my biggest loss years at the exact same time. So revenue was there, but I lost money.
Mm-hmm.
And that was an incredible experience, one that I learned a lot from. So one that now I will watch like my gross margin on my P&L better.
Yeah.
And there's a couple things that I've now put in for myself where I learned to not allow that to happen again. But on the other side, we started going away from value in such a way where people don't come to McDonald's as often as they could or should. And those people who are struggling financially, they're like, well, how can I stretch my dollars? And some of them aren't seeing McDonald's as being the best option. And so that's where we've made some mistakes, but we're getting better at that again.
They don't know how to use the app.
Dude, you're right. You're absolutely right. But
I say that facetiously. I'm an avid app user personally. I hate to, sometimes I don't want to admit that, but
well, the
it
app
is Americana.
Where you're going to get the best deals.
I maybe like a quick business principle to just highlight really quick is, so, here you are, you have this portfolio of all these stores, and from the outside, people look in and they say like, oh man, look at Mark and all his stores. He's like, king of the mountain over here, king of the hill, and just guy, McDonald's guys probably sits on buckets of money. And you're saying like, we had the most sales we ever had in a year, and we ran at the biggest loss we've ever run at.
Correct. I had to borrow money to keep the doors open that year. It was horrible.
Like you literally made no money. Not only made no money that year, you lost money, right?
I borrowed money just to stay open that year where I had one of my highest. It was my highest revenue years that far.
And so you have to mind the farm. So, like in a business, you either have to mind the farm or you have to pay someone to mind the farm.
Yeah.
And as you scale in a franchise particular, like that is typically not a easy position to fill, right? That's a very skilled position.
Yeah.
And then the second thing too is like, what was your experience afterwards? Because you can't, I would think as a business minded person, you can't just go and say, well, I lost a bunch of money last year, so I'm going to make it up for my customers this year. I'm going to raise the cost a bunch, and I'll recuperate all my costs that way. So now my 2 years will even out to 2 average years,
Yeah. I wish that were true. I wish we could go back and actually fix mistakes or try to recapture some of those lost profits. Because not only did I not make any profits, but I incurred debt that year. So it was a horrible year. But this is where data and so one of my business principles, business principle number 12 for me is when performance is measured, performance improves.
Yep.
When performance is measured, the rate of improvement accelerates. So I wasn't measuring the right things and paying attention to the right things. But today we look at, when we're talking about raising prices to be able to keep up with inflation, we look at something called flow through. So meaning if I raise my all right, let's say I'm $10 is my average check, and I raise it, and now it's going to jump up to $10.50 based off of what people buy. Is 50 cents of that actually going to flow down to profit, or are people going to say, I'm not willing to pay that extra 50 cents, and therefore they're going to trade down? Instead of a Big Mac, they're going to get a McDouble. Instead of a large fry, get a medium fry or something like that. And flow through right now is almost down to a zero. So if we raise prices, people are really at that point where they're saying, I am not willing to pay more. So if you raise prices, I'm just going to trade to a different item. And generally speaking, they'll trade to an item that has less margin. And so it hurts me as a business owner trying to make money, trying to make payroll. So it doesn't work. And that really goes into something called elasticity. Elasticity really goes into saying, what are people willing to pay for something? And it's hard because we all have our own budgets. We all have our own idea of what am I willing to pay for this?
Yeah.
And right now people are feeling strapped and they're saying, no, my willingness to pay is I'm fine if you stay where you are, but as soon as you raise it 10 cents, 20 cents, my willingness to pay, I'm done. It's an interesting time, but it's a great time for us to learn, to grow, and to really focus on taking care of our customers and their needs.
Yeah. That's so interesting. I think in the future, maybe I'll have to have you back on as like a a macroeconomic update from,
Yeah, sure.
from the lens of McDonald's on the consumer, because
Totally.
I think I could talk, like, there's so much to be said right now about what is happening in the economy under the surface, and this idea that essentially, like, maybe the quick and easiest way to describe it is like the middle class or Main Street America has actually, in my opinion, largely been in a recession since 2022.
Yep.
But and this is why it's so hard for people to kind of get, is in real terms. So in nominal terms, like maybe you got the raise at work a little bit, you're technically making more money, but your McDonald's order costs more, and fuel costs more, and utilities cost more, and
Your
groceries cost more. Your purchasing power is really down. And so, like, you have gotten the squeeze on in a major way, especially if you've been somebody that has bought a house in the last couple of years. And so it's been really tough, but it's hard for them to point their finger and say, like, man, I'm really feeling poor, when, like, they're like, but I'm making way more than I was 3, 4, 5 years ago. Right. So they don't really, maybe people don't want to talk about it, but I think largely they have actually been in a recession for a number of years. And that data, I think, is finally coming to a head where how much further can it go before the entirety of the economy, right, has a recession? That recession has to flow all the way up to the other end of the K-shaped economy coming out of COVID, which is the higher class, or higher earners and higher net worth individuals, right?
Yeah.
Which that is a whole different conversation.
Yeah. But I feel like McDonald's is actually one of the first people to be able to see it and measure that, because I've been seeing it and talking about it.
Yeah.
And now you're starting to see some of the economists start to talk about the way the economy is going. So if you want to know of, like, insight of how do we know what the economy is doing on a macro level, it'd be like, I would watch what McDonald's is doing and looking at their same store sales year over the year before. And then also when they forecast what they expect for growth. Cause I'll tell you what, that for me, that's the best way of what the economic condition is going to be for everybody across the board.
Yeah. So taking the conversation back to, like, hey, I want to become, I'm sitting in the seat of, I want to become a franchise owner.
Yeah.
There's all these things that we have to deal with as franchise owners. I mean, I say I don't own a franchise. But if an entrepreneur is going to decide to be a franchisee, right, they got to deal with, sometimes working in the business, right? Like, I'm sure there's operators at McDonald's that have, flipped the burger, so to speak, or dropped fries in the oil, right? Like it.
Yeah. Over 60% of us franchisees started as crew. So most of us have worked our way up from the bottom.
But even like since you open the franchise, right? Like there's not probably
today. I serve customers today.
Yeah, there you go. Right. So there's like this element of, like, literally working in the business as like an employee, but then running the business, right, as the CEO, CFO, minding the entirety of the farm that way. That's McDonald's. Franchising in a whole, is it different, or do you think, would you, in your experience and kind of what you've seen within McDonald's, would you say that's probably the optimal model for everyone to take? Like, hey, if you're gonna be in a franchise, you're gonna go open something, unless you're doing the shack model, right? Like, you just you're trying to allocate capital out for private investment opportunities in a really big way, then lean into a franchise where you're going to be the owner operator if you're going to go down that route. Like, don't think you're going to be able to buy it and say, I'm never going to have to work a day in that, and I'll just look at the books once a month and,
of course,
kind of.
So is Shaquille O'Neal, is he Jimmy John's or is he Five Guys? I can't remember what he is. I think it's
five. Well, like I think he's had like a whole portfolio. I don't know. Like,
I think he's Papa John's. Right
from a point of disclosure, I don't do Shaquille O'Neal's finances. So, but I think it was like Five Guys, but I think he did a bunch with like Dairy Queen at one point, Burger King. Like it was this idea is he actually ended up with like a whole portfolio of blue chip franchises.
That's
like,
cool.
But
he's also Shaq, right? He has something that he can offer. He offers his celebrity and being a spokesperson on the side for it.
I mean, he also just has capital to offer, right? Like right. Like most problems can be solved in business if you throw enough money at it, and I think particularly franchises is something like the whole idea there was, you can buy McDonald's or whatever because, you can just insert somebody.
Yeah.
And, like even at the C-suite level, if you're Shaq, you can say, well, I don't need and I don't know what your gross margin is. You don't have to say it, but like, I don't need a 10% gross margin. I can hire the suite, come off with a 7% gross margin. That I'm still totally happy with that because I didn't have to even think about it. Right. It's like truly passive income. And that's, again, that's like the unique advantage of if you have, I don't know what Shaq has, hundreds of millions of dollars, it's like, I don't know for sure. I think Shaq has more capital to allocate than I do. So, that's that model. Diving in though, like if you're going to go owner operator route.
Yeah.
And you're sitting in the seat of, I got to do something, or maybe you don't have to, maybe you just want to do something different with your life, right? Like if you think of the people that typically I've experienced wanting to get in franchises, it's like, I want to get out of, working a corporate job. I want to own something for myself. Sure. I want to pursue the American dream that way. I want to be able to build something where, hey, I can pass on this legacy to my kids of having 18 McDonald's or whatever. Yeah. Right. And like, what does somebody need to do in their personal financial life to prepare for something like that? Is it
there's like, hey, I'll walk you through it. Yeah. What I would recommend. And I can only tell you from my shoes and my perspective. But one of the biggest things is I would first recommend that they go work inside of that business for at least 18 months.
Interesting.
And the reason is you think about all the things that you are going to learn from someone else using their money, their investment, and the mistakes that you're going to make as an employee of that business beforehand that don't cost you anything. Mm-hmm. That's what I would want to do up front.
So you're saying if I was looking today and I said, what, the numbers look really great to start opening Popeyes or something. Yeah. I would want to start getting myself financially ready as best I could that way. But I also want to just go get a job at Popeyes.
Totally. Because you want to understand the ins and outs too, because not only, because up until that point, the only thing you think is, hey, I'm going to be able to make some money. Yeah. And that's it. You're like, I'm going to invest some money here and I'm hoping to get more back in return. And that's all you know or kind of think up to that point.
Yeah.
But then understand what it really means to be someone who participates in Popeyes. And do you actually like the food? And can you be passionate about the product? Can you manage the people and hire the people and then retain the people and deal with the very difficult conversations? Because one of the things you're going to run into in the franchisee is you're going to have people who are key to you and they know they're key to you. And they're saying, hey, I need this in order for me to stay, because people are only going to stay with you if you're helping them achieve their dreams.
Mutually beneficial.
Yeah. So if you're not helping them achieve their dreams, they're not going to help you achieve yours. And so they're going to back out and go find someone else who will. And so a lot of people look at the franchise model and say, I'm just going to be able to open up the doors. They think, that we talked about 25% equity and the cash flow coverage ratio, some of the things McDonald's needs. And then you need your cost of going into business, your COGIB. And like in the McDonald's world, it was like, I don't know, 1.8 million. So you're buying your equipment, your decor, your signage, all that kind of stuff, right? And every franchise is a little bit different.
But that's essentially that's a capital you're going to need to bring to the table.
Yeah. And so McDonald's would allow me to borrow up to 75% of that.
So
right?
they'll finance you in it. Okay.
Yeah. And when I say finance, it's not McDonald's, right? But they have approved banks that can that I
so
can
they help you. They
from.
maybe help you acquire the financing or find the right people, the resources that are willing, that are familiar with that kind of risk and
totally
want to take it on.
Yeah,
okay.
And that makes it a little bit better in some ways because they understand the McDonald's business, and so therefore they have. My bankers are actually McDonald's assigned bankers from U.S. Bank. They only deal with McDonald's franchisees, and so once again, they understand how McDonald's works. They understand my business, they understand the system, they speak the same language. So it is helpful. And you'll find that with other franchises as well. But you're going in through all of that process. And then I don't know. You don't understand, should you open more hours? And then you're looking at each, my last hour and my first hour of each day and be like, well, we're only bringing in $100 of revenue. Does that actually make sense for us to do? All those things that you can learn by being a part of someone else's business for 18 months. Because if not, you're kind of just guessing, making all these business and people decisions that all cost you time and money. And you're probably going to get 10 years worth of experience in that 18 months working for somebody else. And you're doing it on their dime instead of your own. But then you can also be saving that 25%, start working with your bank, start working with the franchisor, do all that at the same time.
So if you need to bring $1.8 million to the table and you need 25, so you're saying
at least $500K. Yeah.
$500K.
And that'll be upfront. And then I would also recommend at least a 30-day revenue, should be kind of be whatever you expect to do in 30 days. That should be like your operating account. So you've got at least that much money as a buffer. Because for an example, you open up the restaurant, I go 2 weeks, my pay periods are every 2 weeks. And so that money's accruing during that 2 week time frame. So when you first open a restaurant, it's like, hey, you're actually building up some money, and then you have to pay, and then you order your food truck, and so it's just having enough money.
Yeah.
Because that money cycles in really fast every single day. Yeah.
What is that? What number does that typically look like at a McDonald's?
So McDonald's, like, well, I mean, there's a couple different things. So I have my 18 restaurants, and I probably pay a payroll of $750,000 every.
Well, that's
2 weeks.
That's like 18. If you're just one person trying to open your first store,
Yeah.
is it like, hey, is that capital? That 1 month of, I mean, is that 30,000, 100,000?
So I would want to look at it as a percentage instead, because whatever your revenue is, you're going to try and make your labor a certain percent and to try to hit, because you're really trying to see what percent you can bring to the bottom line.
Right. But you're saying you need a month of operating income as a buffer. So what is 1 month of operating income for a singular franchise?
For McDonald's, it's usually about 300,000. It's 300,000 to 500,000 a month. And so I personally, though, I fall a little bit. I consider my business a little more stable and something that not volatile, that I know. So in my head, I keep 150,000 of liquid cash for each restaurant that I have. But if you're just doing one in the beginning and you're thinking, I need my 25% down payment, I need to borrow, and then I'd rather have a bigger buffer and say a full months. And so whatever you assume that revenue to be. So in a McDonald's world, I'd say at least 250 to 500.
So you're 750 to $1 million liquid cash that you're needing to open your first store.
And that's kind of a minimum, because the other part is McDonald's says you have to have 25% equity, but the equity is based on how much cash that restaurant is projected to generate. And then we use a multiplier. So they're going to say your EBITDA times this multiplier, and then it has to make the numbers work. And if not, then you have to inject more cash or put more out of your pocket in order to make the numbers work.
And that's because McDonald's doesn't want you to open a location and 6 months later go out of business.
Oh no,
and you know what I mean? Yeah. They don't want to see that because it's bad for brand image, right?
Well, they would make you sell to somebody else. And so they would make you sell, someone else would come in, but you're screwed. I mean, your management company would be bankrupt. Some other management company would come over and take ownership of that McDonald's, and you'd be in big trouble. But I've never seen that happen in the McDonald's world. Yeah. Never seen it happen. I have seen franchisees, you can always spend more than you make, no matter how much money you make. And I've seen some get themselves in financial trouble and therefore have to sell off restaurants, but I've never seen one actually bankrupt themselves. Thank goodness.
Yeah. I think people forget sometimes, like, the big exposure to owning a business is a lot of times you have to take on a lot of debt. And anytime you take on a debt, like if things go sideways, you still owe right? That's why you get rewarded for owning the business, right? Is you take on this risk. Yeah.
I remember the first week of COVID when everything shut down and our sales dropped 65%. And on day one, and I'm like, oh geez, if this is the new norm, I started doing the math, and I'm like, there is almost nothing I can do to try and save the business. Like I was talking to my team, and I'm like, hey guys, just so you know, we love our people and we want our people to stay working for us, but our sales just dropped over 50%. So I need less than half of you to come in to work because I can't afford to pay you. If I pay everybody normally and I wanted to, it's like we're going to be out of business in 6 weeks. If we try and cut it back, I can probably extend us 12 weeks. And that was a situation that I was in. Luckily, things improved quickly and we only ended up being down 30% within 3 weeks and then 20%. And, people started to live in that new norm, as they call it. And we were able to kind of get back to where we were and figure some things out. But that's like the scary truth. That can just happen at any moment. The government can also say, hey, we're going to redo the road in front of your restaurant or in front of your store, and they're going to cut it up, and it's going to impact how many people travel in front of you. And then all of a sudden your business is going to be down 30% for 3 months.
My heart goes out to the franchise owner of Culver's here. That happened to him last year down on Riverside Drive.
Oh, wow.
There was a bunch of construction and, so again, it goes back to like, a lot of times we look at business owners and it's like, oh, look at them up on their, mighty pile of cash or whatever. They don't really realize how fast things can come unwound when you have the risk of a business and operating expenses and overhead and contracts and all these things that none of those people care if you made good sales or not.
Yeah.
Right. You owe the money. And so, he actually got on like St. George word of mouth and said like,
I remember seeing it.
Please come to our restaurant. Like we just please. And
because it was really hard to get to, you had to go around off the freeway off of Dixie Drive or something.
Yeah. It was like, if you didn't really want to go to Culver's, like you were going to go anywhere else. Right. And just that going on for, I think that only went on for like 2 weeks maybe, but that could seriously put somebody from, hey, I'm living the American dream to I've got nothing.
Yeah.
Right. I'm done.
And this is the other part is people, the budget, the principle of having a budget and living by a budget is true no matter what income level you have.
Yeah.
And if people, I mean, that's why these are the types of things that help people get ahead in life is they pay attention to their budget, they allocate funds for certain things, but it's the same thing in business. Like you create budgets and you have to live within those budgets in order to be successful.
Well, an economic principle that drives capitalism is the human condition that humans have insatiable wants, right? Like there's no end to the things that we want, right? Like, and you find that all the way up to the point where you can be Bernie Madoff, the famous and well-known market maker on Wall Street that's very successful in a very legitimate business, but you could get more, And so all of a sudden he runs a Ponzi scheme, one of the biggest Ponzi schemes in history, and it's like, because there's always more you can want. And the code on who wins this game sort of having the freedom are the people that have some kind of discipline, whether it's a budget or you do like, sometimes it's called now like the reverse budget where you say, hey, I'm going to fund my goals and I'll just live on whatever's left. But I'm not going to line item out the budget. Like whichever way you do it, you have some kind of discipline around here's what I want to build for my future. Here's what I'm okay to spend now. And I will live within those means, right? And by doing so, you're living actually really below your means of today because you're funding, the ability to provide for yourself tomorrow when stuff goes wrong, right? And it's tough, but that is the only way to get ahead, right? I mean, not the only way, I suppose, but it is the most likely way, and it's the only way that is a surefire way, which you don't get to say that a lot in finance. Over time, if you, spend less than you make, you should do okay. Right?
Yeah.
Like,
well, it gives you opportunities to have, because in the very beginning, you're trading time for money. And then as you get a little bit older, hopefully now you're having your money also now work for you on the side. And that's the goal. Right in the beginning, but you have to get to the point where you have capital. You have to be disciplined.
So
enough.
You either have to be disciplined enough to put the money aside and little by little grind away at that, because at first it's not right. 10% on $1,000 is not very interesting. 10% on $10 million is super interesting.
Totally.
It's the same investment return, right?
Mm-hmm.
But you have to really grind your way into, it's the same kind of return, but it's all of a sudden really exciting now. Or you have to be the guy that like starts buying Bitcoin in 2009 or wins the lottery, right? Yeah. Like, and I don't know that those two things are really any different.
Yeah,
but
we're not very lucky, right?
Yeah, listen, there's a finite number of people that can happen to, and there's a lot of people in this world. So I generally, almost actually not even generally, I will say I always recommend people do the first, which is put money away and make prudent decisions. But I think there are people that do that and they get to a point where they're saying, I'm grinding so hard, I want to do something different. How can I try to accelerate this journey of building wealth? And oftentimes it's like I'm grinding away at a corporate job where I make six figures. I'm doing really well, but I'm just working for the man still, and so it's this idea of, okay, but if I start my own business, there's some leverage there and I can have some control over my destiny, and maybe it's more risky, right? Mm-hmm. But I've got some personal responsibility and some control over that all of a sudden if I own the business, right? If I do well, I do well. If I kind of mess it up, I mess it up for myself. But that's the trade-off. And I think people are interested in that proposition. I mean, that is the American entrepreneurial spirit.
It's one of the dreams. You can be an entrepreneur or an intrapreneur and be like a C-suite or something like that. I feel like though one of the things that a lot of people are missing that you're talking about, because this is one of the things that I was missing, is I wasn't measuring what financial success looked like. And it's different for everybody. And as you get older or as you acquire more, you're going to feel like that bar, that finish line, it keeps moving forward, at least in my case. I've already acquired more wealth than I ever thought I would. And now my goals have moved just further ahead and further ahead. But we need to be measuring success when it comes to the financial side. Most people don't measure success. They assume that the amount of money they make from their job or their career, that's how they pursue, or that's how they feel comfortable about their success, of financial success. The easiest thing that I recommend is just do a personal financial statement, right? I have to do one every 6 months. My bank requires it. And so for that, it's easy for me to do it. I do it on January 1st and I do it on July 1st. And I actually enjoy doing it. But I look at it and I compare where I was 6 months ago, where I were 2 years ago. But that's one of the easiest tools to say, am I actually creating success with what I'm doing? Because if not, then you start changing the formula, or start adjusting what you're doing.
I think one of the things I found really interesting, like to me, that's table stakes. Like that's just putting together an accounting statement.
Yeah. But how many people do it, and how many people measure off of a year ago, 2 years ago, 3 years ago? And
listen,
say,
I can tell you it's near no one, because I think in the years I've been doing this, and the hundreds of consultations I've done with people, primarily in this community here in Southern Utah.
Sure.
I have had, I think, 3 people come in and be like, here's my personal financial statement.
Or they could even tell you some of the numbers off of it or something.
Well, a lot of times they can tell you like the numbers, but like somebody that says like, yeah, here I printed off my spreadsheet, brought it with, I thought this could help in the conversation.
Yeah.
You know,
do most people have an end goal of how much money they want to have, or what they think they're trying to?
At least people that come in and talk to me, no, unless it's a very arbitrary thing, like, oh, I want to have $3 million when I retire.
Okay.
And so the question I try to take it through, like when you talk about how do you measure success, is, okay, like money is just a means to an end, right? So what we want to talk about, values and goals, right? And quite frankly, I think goals are really just a way to live your values, right? Correct. Because no one says like, I love my family, I want to spend time with them. My goal is to go on a cruise by myself. Like the goal is a way to spend time with your family, right? Or the cruise is a way to spend time with your family, rather. And so I think when people can make this transition flip from I'm putting money away to have a certain number in the account, or be able to produce a certain amount of income in retirement, which a lot of times is what you kind of have to resort to sometimes if you're planning with the mass affluent. But when you can get it to a point of, oh, I'm stuffing money away because I'm trying to have the ability to, buy the cabin on Bryan Head and spend all summer up there with my family or whatever. Right. Like, and it's just like, that's all of a sudden, that's the way that they measure success, right? Is when I can spend less time at work and more time with my family. Sure. Here's what that looks like. Then funding that becomes more interesting, and driving towards that becomes more interesting. But also when you get there, you don't get there and say, well, I want to spend more time with my family. Now I want to spend more time with 2 families, right? Like you can have a sense of fulfillment in that. Now, if you set out and your vision is to spend time with your family on a private jet, it's going to look different than if your vision is to spend 100%. More time at home playing board games as a family, right? And just working less. So it's a very personal thing.
It is. And
I'm not even saying that everyone's value set has to be spend more time with their family. But what I found is there is a disconnect a lot of times when you help somebody identify what their values and goals really are, and then you listen to what they want to do financially. There's a big disconnect. I think I had a really good teaching opportunity with a client last year, actually, that was looking at wanting to buy franchises, and the conversation was around, the value set was wanting to spend more family time, simplify life, work less, all of these things. And then they say, well, we want to buy a franchise. Yeah. And I'm going like that, those 2 things don't compute, right? Like even if the value, like even if the return, right? If they sit down and the guy selling the franchise says, "Oh, this is going to do, a 20% net profit a year. This is a great return or something on your capital." It's like, yes, but you're adding a huge complexity to your life that you don't need to add, and it's counterproductive to living your value set. And so, if your idea is you just want to get more assets, then build more truly passive assets, right? Like, don't build a franchise. For some people, franchises are, right? Obviously,
Yeah.
they're great. But if you're at a place where you're like, hey, I've got a lot going on already. I've got a high income job. I'm trying to figure out how to not be working actively in a couple of years. The last thing you want to do is, and that's driven by a value set of spend more time with your family. You don't want to go buy a franchise. Right?
Well, you shouldn't. But that's where people have the misconception. I mean, there are franchise groups you can buy into, like Subway. You can have like 30, 40 owners as a part of a Subway, and then you're just collecting a check and you're paying a management company on the side, kind of like just buying.
It's like syndicated real estate
or VRBOs, right? It's kind of like the same thing.
But at that point, it's not really buying you're not really buying a franchise. You're just buying a private investment.
It's exactly right.
Because if you're just buying a private investment,
Mm-hmm.
and all else being equal, put it on a spreadsheet, put it on paper and say, is this a good investment relative to my other options? What are the complications or risks that come with that?
Yeah.
What am I trying to accomplish by owning this? And it can become a black and white conversation, right?
It can be. Yeah. Just look
like
at the numbers and, past experience does not guarantee future success, but generally speaking, it's the only way to do it. I mean, there's not many other ways to do it. That was the other thing that I wanted to bring up when you're talking about franchising, because a lot of people will say, well, which franchise should I go with? And they ask like, because they think that because they love the product or they love the service, that they think that therefore everybody else is going to love it and then they should buy it. But I like to see a franchise that has gone through some experience and some history, meaning like they had ups and you can see where they've had growth, and then they've had some type of their own personal recession or a downtime economically, and then they've been able to get past it. Because most franchises today are still so new that they're kind of trendy. And because it's trendy, it's like you don't know what they're going to do long term when they've only been around 4 or 5 years and today they're hot. But what's going to happen when they have the downturn, and then can they recover and find some way? That would be a franchise I'd want to look for, not something that's trendy and hot today. I would want to know one that's had some bad days.
Can I ask your opinion on a trendy franchise?
Oh, sure. Yeah. I mean, I may not know about it, but sure.
Oh, this is Utah. You'll know about it.
Yeah.
Crumble Cookie.
Well, and so I don't know enough about the details of their business.
Oh, yeah.
To be able to help on it.
Is that would that be like an example of something though where you say
it's
they don't have
trendy,
a long what they've done is impressive,
Totally.
right?
Yep.
But in the world of lasting business, it's really new still.
It is very new.
It has not gone through a full economic cycle. You don't know what a major recession looks like to a Crumble Cookie or a Swig or.
Yeah. And for me, that would worry me a little bit. Just because if there is some type of change, or say there's some MAHA, make America healthy again type movement, and they say, hey, we want to limit these from this types of sugars or this type, and it changes their formulation. I mean, I don't know what they're going to be able to do to get around some of the possibilities in the future. It's
really interesting that you bring that up, because I have a saying about risk that, okay, so risk can't be created or destroyed. It's like energy; it can just be converted. Right? Yep. So you actually, like, everyone in the financial world always wants to like try to quantify risk, and it stems from two things. I think one, academia, and then two is like just a simplicity, right? If we're talking and I say, well, 0 to 100, this investment is a risk score of 60. It's you go, well, that's less risk than something that's 100, or it's more risky than something that's a 2. It's very intuitive. Yeah. But the problem is in reality, everything's 100, right? Money market's 100. Well, how do you figure? Well, you're not taking on the risk. On the other ones, you can quantify the risk of the account balance going down, maybe, or the value of the investment going down in nominal dollar terms. But if you sit all your money in money market account your whole life, you're taking on this huge risk called inflation risk, right? And that's huge and massive over time, right? So like there's some people say like there's the risk in not taking risk, right? Like I just say there is always the same amount of risk. It's just what are you going to trade off, right? And so the trade off might be, I'm willing to, I want to get rid of this risk of not having control, because I don't, so I don't want to buy, stocks in the stock market because I don't control those companies. It's, whatever, right? Like I hear that,
Sure. Yeah.
So I'm going to open a crumble cookie. And you think, so I control the business. I do all this. I largely have all the control. But you just took on the risk that the government comes out of nowhere anyways and says, you can't put.
And you're the franchisee.
Whatever.
You have to play by the franchisor's rules, which is a risk that they're going to do things the right way and they're going to play by the right rules and give you the right advice. And
so you can open up your own boutique shop, your own boutique cookie shop that replicates what they do. But your risk is that you don't have the brand image, or you have, or you run the risk that your pockets aren't as deep as they say that was a really great spot on town. We're going to open one across the street from you. And we're going to do more marketing and undercut your price for a year and put you out of business.
You talk about it as risk. I talk about it as probability. But it's the exact same thing. What is the probability of this happening? And then I play with it that way. But
a lot of people don't think that way in terms of looking at risk holistically. Mm-hmm. They just say, well, what's like, if I put $100,000 into this investment, how risky is it? It's like, and what they're looking for is somebody to quantify and say, well, it could go to 90,000. It could go to 120,000. Right? Yeah. That's your risk.
They're
it's
trying
like,
to give you
that's not risk.
They want a range.
Yeah. It's like, that's not risk.
No, it's like 100% risk. It could go to zero.
Well, in franchises. But there's if in fact, and there's some things that like really would be almost like the world is ending if it goes to zero. Right. But you just take on another form of risk, whether it's a liquidity risk, inflation risk. There's all sorts of risks that you are taking on that they're just not in the math of, that range.
But there's also the risk of doing nothing, the opportunity cost that nobody talks about. Because for me, that's the biggest one.
100%.
When I was very young, every dollar I made, I had a really hard time spending money. I was extremely frugal. And it was because I understood the opportunity cost of using that money for something fun or going out to eat or whatever it may be. Because I knew that investment opportunities were going to come my way and I wanted to have the opportunity to take them. Everybody in this world gets great investment opportunities. They get great opportunities because you're living in a free country that operates with capitalism. So you're going to have great opportunities, but you have to be available and ready at the time that it comes. And if you don't have the capital, you don't have the cash to be able to do it, you miss out on those opportunities. But there's always risk, and the probability of having an investment, 100% for everybody. But you being ready at the right time, that's a risk.
Yeah, that goes back to if you have a portfolio that's fully invested all the time.
Yeah.
You have the risk that you can't swing at the fat pitch that comes.
Yeah.
You know what I mean? That's just like, right. So there's always some kind of risks, and it's just a matter of what risks are you most comfortable with, and how do you want to trade and rearrange your risk exposures to say, like, okay, so I've traded risk A for risk B, but I'm more comfortable with risk B, or I'm, maybe I'm comfortable with a little bit of risk A and a bit of risk B and some risk C, and altogether it seems like something that's most manageable.
People got to be riskier. Like when I came home from Iraq, right, that one of the first things while I was in Iraq, I had a bunch of time to read books. So we're up in the middle of the night. We would drive around, we'd go find IEDs, and then we would park, and at night I would read books. And so I'd read all these real estate books. So when I came home, my first house was a trailer home, and then I bought 3 more, and another one, and I would fix them up and I would flip them and I'd rent them out. But it was just because I read some books. And then, so now today, my risk level or my comfortability in buying real estate, it's great. But that's just because I took those initial risks, and I took those initial risks because of the comfort by reading some books. And so that's why coming talking to a guy like you can teach them, educate them, make them feel a little better about their situation, a little more comfortable, and then they're willing to risk. Yeah. But you've got to go talk to some people, read some good books, and then be willing to actually take some risk.
Yeah. I think largely people do not take nearly enough risk. I absolutely agree with you on that.
Yeah. Well, but if they came
or they take all of the risks in all the wrong ways.
They're just gambling on everything.
And that one, I'm like, ooh, okay, that one wasn't even calculated, that one's,
well, that's where you gotta
but
talk to people that you're willing to trade shoes with them, right?
Mhm.
You don't take counsel from people who you're not willing to trade shoes in that particular area. And so if they can tell you how to invest because they've done it or then that's the guy you want to listen to.
Well, I think there's an integration there with your first point, which is or a point you made previous, which is how do you measure success,
Yeah.
right? And so the thing that I always caution people is like, be careful how you determine who it is that you are willing to trade shoes with, right? Like I had somebody say this to me once, and they're a tax attorney, and I'm like, I respect the heck out of you, and I absolutely would be happy to hire you for tax advice, legal tax advice.
Yeah.
I would never want to trade shoes with you, like ever,
Yeah.
like completely different life, that me and this individual lives. And there's nothing wrong with that. Great individual.
That's him doing him and you doing you. Yep.
Yeah. Right. But that individual had said, don't ever take, advice from somebody you wouldn't want to trade shoes with. And I'm like, well, you're asking me to take legal advice from you, and I wouldn't want to switch shoes with you,
Yeah.
So like,
And I put it to that particular area, right?
Right.
Not-
Yeah.
not
If you want to be a
everything in life, but
franchisee, go look at somebody that you emulate or could look up to, or find a mentor that has franchises,
Sure,
right? Like
yeah.
I think that principle is correct. But I guess really what I cautious people to is, don't look and do the silly thing of saying, that guy's got a really nice boat, I want to do whatever he's done.
Right.
Because you just don't know what the rest of the situation really truly looks like. And so unless the way that you intend on measuring success is just having a boat,
Yeah.
that boat, then, that might not be the person you still want to get the advice from. Right. So, it goes back to, if people take the time to really try to just put on paper some simple value sets, what are the most important things in my life?
Mhm.
Right. And what are my goals to express how I'm going to live those value sets. Right.
100%.
Then you can start saying, well, I want, I want to, my value set is to leave a legacy, right? Okay. My goal is to open a bunch of franchises so that I can leave that legacy to my kids in a turnkey business, right? Well, now I know where I want to be. I know how I'm going to kind of do it. Now I can go find a great franchise operator and start talking to franchise operators and say, where is one that not only are they successful in what they're doing, but maybe like the whole thing's in alignment, right? Like there's a difference between the guy that figures out how to open up all the stores, but it has a really crappy personal life, or
Sure.
no one likes him.
Oh,
Or,
dude,
you know what I
yeah.
mean? Like
Right.
can't keep it together. Like all he knows is his franchises. Listen, and if your goal was to accumulate as much wealth so that you could have a yacht, and the way you were going to do it was open 100 franchises, then you want to go find that guy, right? Like,
Right. That's your guy.
but if your goal is but if your value set is to have assets to leave behind as a legacy to your kids, like that sort of inherently means you want to have a good relationship with your kids. And so you want to find the guy that is being able to maintain his franchise portfolio or whatever it is, right? I mean, car dealerships or, any small business that, maybe it's not a franchise, but it's just their own small business, or an investor of any kind, or a real estate professional, or a professional in any career track even, right? Do they have both the acumen you're looking for in that kind of skill trade type idea, and are their value sets still the same as your value sets,
Yeah.
right? Like,
Dude, I love it. Actually, you break it down perfectly. What you just talked about, because I do the same thing. You're saying value sets. I say vision.
Sure.
But it's the exact same thing. You set goals to get you to your vision, and then you set daily, weekly, monthly routines in order to achieve your goals, to achieve your vision.
Yeah.
And that's all you try to do. But you've got to be able to measure success. And it's how are you measuring success? What is your top KPI on measuring financial success? That's it.
But I think you measure that in the goals, but the goals are only the key is to make goals
Mm-hmm.
that allow you to live your value set or your vision, right? So your goal could be spend 15 hours a week at home with the kids or the wife, or do 2 date nights a week, right? Like, so maybe everything you're doing is figuring out now just how to buy back your time so you can be able to do that. But
Great
if
book,
that's
by
the
the
way
way.
that you measure success, right? Like, then like you can measure that in the goal happening. But the reason that was your goal was because your value set was, spend more time with the family, or deepen my relationships, or, whatever, right? Like,
And then you set those daily, weekly, monthly routines in order to achieve the things you want. Yeah, it's exactly, dude. It is the model, and you follow the model, it works. You follow the model,
yes.
it works. Yeah, with consistent and diligence and
Well, the results take time to measure.
Yeah, they do.
Habits and discipline get people further than luck.
Yeah,
doesn't hurt to be lucky. But
doesn't hurt.
It doesn't hurt.
But I also believe, the harder you work, the luckier you get. And so, being in the right place at the right time is because of the hard work and everything you've done to be able to be there. So,
I think sometimes
they all go together.
Yeah. Religious or not, however you want to phrase it, I think sometimes the universe sort of has a way of rewarding the people that have put the work in.
100%.
You know? So, and sometimes the work is not, not the fun and glorious things, but the small and tedious and the very forgettable tasks, right?
It is.
So, anyways, yeah, that's a whole nother thing. So, well, it's a lot of interesting information about franchises.
And there's a ton. I wish we could spend more time and I'd tell you everything about it. It takes a ton.
Yeah.
Yeah. Ton of information.
If I ever open a franchise, it would be a very long time from now, and it would be the Shaquille O'Neal model personally. It's not where I have an edge, right? But I find it very fascinating, and I have some great friends that have been franchisees, franchisors. I've got a friend that represents a company that brokers franchises,
cool.
Right? Sells franchises, right? Yeah. So there's a lot of really interesting stuff in the space, and there's certainly opportunity to be had. It's a very interesting angle on the American dream that I think makes it somewhat accessible for people that otherwise would have a very difficult time going into, you know what I mean? Like if I can open a McDonald's or I can start my own hamburger stand from scratch, right?
It gives you the model and the formula to be an entrepreneur without having to invent it yourself.
Buy the blueprint to success sort of thing,
exactly.
Right? And so there's a lot, I think a lot of opportunity people should be considering, and just, consider, if it's really right for you, and, do you have that kind of capital to deploy or think about or risk, or, who do you need to partner with to get it? And I think there's probably a whole nother episode to be done where I bring on a business attorney and say, what are the nuances of, having partners that no one ever talks about, right?
Well, and the franchisor might not allow it. So you got to understand that when you're playing with each franchise model. Some do, some don't.
Yeah.
Yeah.
That's okay. Interesting. Good point there.
All right. So like McDonald's, for an example, full-time and best efforts, right, is what they want me to invest. So I can't bring on financial partners because they would require them to give full-time and best efforts.
Yeah.
And most of the time, financial partners, they're just an investor. They're not looking for, they're not looking for a job or something to be involved in. They're just trying to assist with funds. Yeah. So anyway, there's those different separations.
Sense. Yeah. Well, if anyone wants to get in touch with you about McDonald's or picking your brain on franchises further, where does somebody find you?
I do this thing. It's called the Franchise Formula. So it's a website I have. I've also got, Instagram, YouTube, all that kind of stuff. But I talk about all these types of things that we've been talking about today. And I break it down. Today I tried to go a little more specific, less high level, because you're the people that are listening to you are very financial savvy people. So I was hoping to be able to give a little more detail for them. And then on YouTube and stuff, I'm very broad. I'm going to explain it from, if you're a 5-year-old kid, and, make it as easy as possible to understand and break it down step by step, what you should look for, what you shouldn't look for. But the franchise formula. And then the other thing that I do quite a bit is I talk about business principles. It's kind of what we've talked about today with vision, goals, and then routines. And I incorporate them into the family life and talk about that, because leading a business, leading your family, leading your life, they all follow the same kind of models if you want to be successful in all three. Yeah. So really cool. Yeah, I appreciate you. Thanks for letting me come on.
Yeah. Thanks for coming on.